So there's one common word that we've looked at, and that's the word multifamily. When I first heard the word multifamily back in the year 2000, I thought, what does it mean? Does it mean the cousins are coming to live over? Do we have 3 or 4 families living in the one house? Then I tried to relate it to Australia. There is no equivalent term for multifamily assets in Australia. There is only one developer in Australia who's doing something remotely close to multifamily, and surprise, surprise, he's also Australia's richest property developer, the only billionaire property developer we have. I'm talking about Harry Triguboff, who implements a very similar strategy. Not quite how it's done in the US, but again, interesting concept. So the proper definition of multifamily assets is this. Multifamily housing is a form of residential property that has 2 or more units in the same building or complex. And it's basically made up of 2 different categories. You've got those that have between 2 and 4 units, what we would commonly refer to here in Australia as duplexes and triplexes. This is not what I'm interested in, and this is not what tonight's presentation is about. What tonight's presentation is about the commercial aspect of these assets. You see, 2 to 4 units are still categorised as residential property. They're bought by mum and dad investors with mum and dad loans. Anything above 5 is now categorised in the US as commercial property, even though it's being leased out or rented to residential tenants. Now, typically the ones we're looking at have upwards of 50 units plus. So we're looking at 50, 100, 200, 300 units in the one complex. Now, what makes this asset class unique is this. In Australia, if you were to invest in an apartment, you would go out there and you'd go to a beautiful apartment building and you would buy apartment 707. And you would own apartment 707, and somebody else would own apartment 708, and so on and so on. If you choose to live in that, then you'd be called an owner-occupier. If you choose to rent that, then you would be an investor, correct? Well, in the US, that exact same apartment is not referred to as an apartment. It's referred to as a condominium, all right? So when they refer to the word apartment, if you own an apartment in the US, it means you own the entire complex. If you have think of condominiums as strata titled, yeah? And think of multifamily assets as apartment buildings where there is one owner to the entire asset or one institution to the entire asset. Now, that doesn't mean that they could be separate titles. They could be separate titles, but they are managed as one complete asset. And these are some pictures of some real assets that are being managed by our partners in the US. So, as you can see here from these pictures, they provide very good facilities for tenants. There's different qualities. You've got really good qualities like this brand new building here, and then you have older buildings like this one here, and I'll talk more about that as well. They come with things such as clubhouses for tenants to hang out and pay their rent. They have on-site property management. They've got within the clubhouse, you've got facilities there for people to get together and you can book out the clubhouse. You've got pool tables, you've got bars, you've got lounge areas to watch the football, you've got volleyball courts and tennis courts, and as you can see, it's an entire complex. Now, who are their tenants? Who are their clients? Their clients or their customers are the tenants. So with so many of these apartment blocks in the US, and they are extremely common in the US, and they range from the most expensive areas right down to the cheapest areas. They've got business centres inside, and as you can see, even inside they're quite nice. They're not least furnished, so they're not furnished apartments. They are exactly what you would rent if you were renting here in Australia. So this visual reference gives you an idea of what the multifamily asset class actually is. Now let's look at it from a fundamental point of view. First of all, you need to understand that multifamily properties are in the business of being professional landlords. First and foremost, this is a business that you're buying that happens to be backed by real estate. Does that make sense? It is a business that is backed by real estate. It is a business that is professionally managed by professional and specialised operators with very specialised skills. Do you remember how I said the property managers in the US are nothing compared to our property managers here in Australia? Well, let me tell you that the best property managers here in Australia have nothing on multifamily asset managers in the US. Later on in tonight's presentation, I'm going to go into the specifics of exactly what technology they have and what resources they use to manage these assets. They manage them as a business. Most importantly, multifamily assets or apartment buildings are fundamentally designed to operate profitably, as any business is, and they're valued on their ability to do so. I have a very good friend of mine here in Sydney that operates a very popular Sydney business brokerage that specialises in coffee shops, cafes, restaurants and so on. His name's Stephen, and I said to him a few weeks back, I said, Stephen, how do you value a business? He goes, it's real simple. He goes, we look at the income that's coming in, we look at the expenses, so we can work out the net profit, and then depending on where the coffee shop is, we would get between 2 and maybe 2.5 times that multiple. I said, so what you're telling me is if you had a coffee shop that produces an income stream, a net income stream of $1 million before tax, then you could sell that for, say, $2 or $2.5 million? He goes, that's exactly right. I said, what if the coffee shop up the road also makes $1 million, but this coffee shop has a much nicer fit out? They've got marble tiles. They've got a much more expensive fit out. Would that be worth more? Do you know what he said? He goes, if that extra tiles or the extra fit out doesn't generate more income, then the value of that business is still the same. I said, Stephen, why does a company like Starbucks then trade for something like 20 times its net operating income? He says, that's very simple, Danny. He says, if you're buying a coffee shop on George Street, Sydney, that's sold to Mr. and Mrs. Smith, and they're the sole operators of that coffee shop, and it's at the bottom of the Sydney Water building, and Sydney Water decides to move out, as they did a couple of years ago, then your business is at a high risk. So an investor is willing to pay 2 times earnings to carry that risk. But something like Starbucks, in particular in the United States, it's huge. It's completely run under management. So what he's saying is that the quality of that income, the quality of the investment of Starbucks is far greater to an investor than the local coffee shop. Now I need you to keep that in mind because I'm going to come back to that in just a moment. You see, these assets are valued in exactly the same way. The value of this asset is its net operating income divided by the capitalisation rate. Now I need you to remember that word capitalisation rate because it becomes one of the most important words when you're talking about multifamily assets, and one that I'll be mentioning time and time again throughout this presentation. So let's define each one of those terms. The net operating income. I jumped onto Investopedia, I typed in net operating income, and this is the definition that came up, and I was quite surprised that it wasn't actually a real estate term. Because if you look here, it says a company's operating income after operating expenses are deducted and before taxation and interest. Then I looked up capitalisation rate, and the capitalisation rate is nothing more than a rate of return based on an expected income that that property is willing to generate. Now that's a fancy way of saying it is the level of risk associated with that property. The level of risk. If you've got a brand new property, right, that is what we call a Class A property, then that represents a lower risk proposition than if you have one that's 50 or 60 years old. Now, there's 2 parts to this. When you're valuing a coffee shop or if you're valuing multifamily assets, there's the quantity of the income, which is how much is the income coming in, and the second thing is the quality of the income. So these assets are divided into 4 different classes. The first one is called a Class A asset. Now, the same thing that we refer to here in commercial terms, a Class A asset, are the most expensive, most luxurious properties. These ones here are usually less than 10 years old. They're rented to tenants who want to be renters. They're renters by choice, and they're typically bought by the large institutional investors. Then you've got a Class B asset. Now Class B is just a level below. They're a little bit older, so they may require a little bit more capital expenditure. They're still quite nice, so the people who live there are a combination of renters by choice and renters by necessity. But what they have is they have a slightly better yield, rental yield, than a Class A property, because the quality of the income is slightly less. Then you get a Class C, which is one level below that as well. These ones require a little bit more money to be spent on them as in terms of capital expenditure, and people who live in Class C properties are typically people who have no choice but to rent, which makes up a very large portion of the population. Then there's a 4th class that I'm not even going to talk about. These are the Class D assets. These are the ones that have extremely high yields, but these are the ones you wear bulletproof vests to go and visit. They can quite easily become slums. There's a great opportunity if you've got the courage and the knowledge and the expertise to buy these assets, but most institutional investors won't go below a Class A or a Class B asset. Now, I need you to remember this as well, because I'm going to talk more about this when we talk about our investment strategy. To summarise, the asset value is determined by both the quality and the quantity of the asset's income stream. Now, to work that out mathematically, if you've got a 100 apartment complex, and let's say that apartment complex is generating a net operating income of $1 million, if you're buying that as a Class A asset, you're going to pay $25 million for that asset. So it has a capitalisation rate, or cap rate, of 4%. So if you're going to buy it as a Class C asset, the cap rate's going to be 10%, and you're going to pay $10 million. Does that make sense? Yeah? So To make $1 million, you can either buy a Class C property for $10 million or a Class A asset for $25 million. Now, $25 million seems a lot more expensive than the $10 million. And there's a reason an institutional investor is willing to pay more for that asset. Later on, when I start talking about rent growth, I'm going to come back to this exact same chart and show you how that affects it and how the large institutional investors have already pre-calculated that into its valuation. So real estate all over the world is exactly the same. The higher the risk, the higher the return. Your highest returns are going to come from things such as land development. They're also going to come from things such as property development. Are these risky investments? Yes, they are. There's a potential, and I've invested a lot of money and developed a lot of property here in Australia. I've made money, and guess what? I've lost money in property development. And you need to understand that these high risk, high return assets are capable of making very good yields and very good income, but they come with a level of risk. Then you move down to the more what we call the core and core plus assets. Now, a core asset in commercial real estate terms is often referred to what we call a Class A property. A core plus asset is where you have a little bit more potential to improve upon that asset. There's one word up here which I want you to focus on, and that word is repositioning. Now, the repositioning of these assets, in the past 5, 6, 7 years, a lot of high net worth Americans, people who are worth $100 or $200 million, they started buying a lot of these multifamily assets, and they believed that they could do a better job at managing these properties than what some of the other property managers were doing, and they would manage these assets themselves. Now, quite often, if you own the property and you're managing the property, and it comes time to start spending a bit of money, the natural instinct for a emotional investor is to keep the money in the pocket and think, oh, I can get away with this. And what happens is these properties start to deteriorate. As these properties start to deteriorate, new tenants, new clients coming on board think, oh, this one's not quite as nice as the one next door, and they start paying less in rent. As the owner starts receiving less rental income, it starts increasing the justification of spending less money. So it becomes this downward spiral. Now, what the repositioning of these assets means is you get specialised companies that will go up into these assets, and they will start managing these assets to bring the market value of rent back up to market. It may improve the cosmetic renovation, and it's repositioning these assets from a low, maybe C-class grade asset, all up to a B, maybe even an A-grade asset. And I'm going to show you an example of one a little bit later on. So that's the next term I want you to remember for later on, repositioning.